what's happening, and it's slow. The institutional adoption is happening, and you can see it in the ETFs. The ETFs make it super simple to buy these things and to buy Bitcoin, because prior to this, you really couldn't. If you were an institution, it was very difficult to buy Bitcoin. We print money. That's what we do. So we'll never default. Why won't we default? Because we print money. No sovereign that issues debt in its own currency would ever default. Why? Because they can just print money and buy their own bonds. Look at what Japan is doing. They're doing the exact same thing. They've been doing it for years.
James Lavish begins by addressing the significant shift in perception among institutional investors regarding Bitcoin. Initially, many on Wall Street dismissed Bitcoin, claiming it lacked underlying value. However, this sentiment is gradually changing. Investors are beginning to recognize Bitcoin's potential, seeing it as an interesting asset worth exploring, although many still don't fully understand it. This evolving curiosity marks the beginning of institutional adoption. One of the primary barriers to institutional investment in Bitcoin was the operational difficulties and associated risks. Previously, buying Bitcoin required a complex process involving numerous approvals and personal risks for portfolio managers. This deterred many from engaging with the asset. However, the introduction of Bitcoin ETFs has simplified this process significantly. ETFs allow institutions to buy Bitcoin with the same brokers and on the same exchanges they use for other regulated investments. This regulatory alignment and operational ease make it much more straightforward for institutions to incorporate Bitcoin into their portfolios. Lavish highlights that the existence of Bitcoin ETFs has effectively mitigated the risk of institutional investors sticking their necks out to buy Bitcoin. The ease of purchasing Bitcoin through these ETFs has shifted the narrative. Now, institutions can acquire small positions in Bitcoin without the previous operational and career risks. This incremental approach, known as legging in, allows institutions to start with a small investment and gradually increase their holdings as they become more comfortable with the asset.
Hard line from most of the Wall Street institutional investors that, oh, Bitcoin doesn't have any underlying value, to, oh, this is interesting. I can see why it's something interesting to trade. And so they're dipping their toe in it. But what's important about that is not that they understand it yet, because by and large, the people I talk to on Wall Street still don't understand it fully. And that's okay. It took me a long time too. There's a lot of mental resistance there when you're part of a system that benefits you so well that you're looking at something that's completely different. It's very difficult to get your head around. But that said, what's happening, and it's slow, the institutional adoption is happening, and you can see it in the ETFs. The ETFs make it super simple to buy these things and to buy Bitcoin, because prior to this, you really couldn't. If you were an institution, it was very difficult to buy Bitcoin. And the reason for that is just it was operational difficulties. It was career risk, it was personal risk for people, for investors and portfolio managers, to stick their head out, stick their neck out and say, I'll buy some of this, I'll take the risk, and I'll hold the keys or what. It was very difficult for them. And then you'd have to have a lot of approvals internally to get to the point where you could actually do that. Whereas now with the ETFs, it makes it very simple. You can buy it with the same broker on the same exchange that you normally do, that's regulated. It's not an unregulated exchange. You can settle it with the same prime broker as you always do. You don't have to have a different prime broker. You have a custody with that prime broker and you DTC it, so it's all settled and held and in the same way as a regular investment, and it's marked the same way on the New York Stock Exchange time. It's these questions are all settled, they're answered, and it makes it super simple. You just buy it just like any other stock. There's no margin on them right now, as we've come to learn, but it's the same exact thing. So it's kind of that risk of sticking your neck out and buying it early is shifting now. And so what you're seeing is people say, well, wait, what about this thing? And it's forcing them to do a little bit of work on it. And it's very easy for them to just go and get a small position. And we call that legging in. You leg into the trade, you get a small position, and it forces you. You say, well, it's in my portfolio now. Every day you pull up your portfolio, it's right there. It's staring you in the face. You don't have a choice, but you've got to look at it and say, do I want to add to this or take it off, because right now it's just an annoyance. It's a 0.5% position. I got to do something with it. And so that's kind of where we're at, where you've got a few institutions, a lot of hedge funds are trading it. You've got a few institutions that are starting to get in there. But really, Sam, what I think is going to be the big catalyst is now we're bumping up against that period where the institutions that have bought the ETFs, they have to publicly disclose that. And we're going to start seeing some institutions publicly disclose it. And it's not because, and when they disclose it, that's not going to be like, oh, wow, look, the Cleveland Fireman Fund owns some Bitcoin. That's what it means is, oh, look at all of these institutions and these professional investors that have bought this thing. It's kind of turning where I better do my work on this, because now I'm getting behind. They all own this thing. I don't even know what it is. It's so that risk of buying it has flipped to the risk of not buying it. We're still in the stage, as you know, that people consider this thing in Wall Street and typically across the nation, they consider this thing a risk on asset, and it's going to take a while to change that. But this is the beginning of that, and that's what's really important about it.
The critical turning point, according to Lavish, will be when institutions publicly disclose their Bitcoin holdings. This disclosure will not just highlight individual investments, but will signify a broader trend of professional investors embracing Bitcoin. As more institutions reveal their positions, the risk will shift from buying Bitcoin to not buying it. This change will force more investors to research and understand Bitcoin to avoid being left behind. Lavish also touches on the broader economic implications of Bitcoin and how it fits into the current financial landscape. He discusses the role of the Federal Reserve and its quantitative easing key policies, which have expanded the money supply and contributed to inflation. The Fed's actions, such as buying bonds and mortgage-backed securities, inject money into the system, leading to an increase in the money supply and eventually inflation. Understanding the Fed's monetary policies is crucial, as they have a direct impact on the financial markets and the economy. Lavish explains that the Fed can essentially print money to avoid defaulting on its debts. This ability to print money and buy its own bonds, similar to Japan's approach, ensures liquidity in the markets. However, this perpetual increase in the money supply contributes to long-term structural inflation.
Printing money with QE, basically, in times of distress. And when you see a real fast expansion of the money supply. And what's really important about that is that that's what adds to inflation. We've seen it. We've seen that how it exacerbates inflation. That's what we're talking about here. And what's, it is, I did write a whole thread about it, so I won't go through the whole thread here and waste everybody's time. You can read it. It's on my Twitter today. But the punchline is the Fed goes out and they commission banks as intermediaries to go and buy bonds in the market for them, both treasuries and mortgage-backed securities. And they'll go and do that. And then the Fed just kind of presses a button and enters reserves on their balance sheet to pay for them. So then they can pass that through. And it's just money entering the system that wasn't there prior. And so it expands the money supply. You can see the expansion of the balance sheet of the Fed and the expansion of the money supply kind of go lockstep. And then there's further on, there is, and we didn't talk about inflation in this thread, it was just about the money printing, but you can see a delayed effect where inflation starts to hit after the expansion of the money supply. So that's what's so important to understand about it. And so they basically can just print money. And they've said this before. They've said it on 60 Minutes. They've said, we print money. That's what we do. So we'll never default. Why won't we default? Because we print money. No sovereign that issues debt in its own currency would ever default. Why? Because they can just print money and buy their own bonds. Look at what Japan is doing. They're doing the exact same thing. They've been doing it for years. And so they're running into issues with it, but that is exactly what's happening. And so that's what we have to, that's what we have ahead of us. So I think we have continued perpetual structural high inflation. And the reason we have that is because we must have liquidity in the treasury markets, and that means that we must maintain liquidity across the economy and across the markets in order to maintain that liquidity in the treasury markets, because we're not going to cut expenses. We're already spending more than we are legally bound to with mandatory expenses and with long-term contracts with the defense contractors, and then just the interest on our debt. Interest on our debt is $1.1 trillion right now.
Stupid.
It's ridiculous. Of course, they get some of that back because of internal holdings, but it's over $800 billion that we're spending each year on interest on the debt. And at the same time, we're spending roughly $4.1 trillion on mandatory expenses, Social Security, Medicare, Medicaid, unemployment. So just add those up, that's $5 trillion. When Sam, we took in $4.4 trillion of tax revenues, or that's what we're expected to take in this year. I mean, you don't have to be a math genius to see that that's not sustainable. Like, we have to do something, and so that's kind of where we're at, and that's why the money is printed to continue. Because when we have these times of shock, we cannot have the treasury market act dysfunctional. Like, it has to keep functioning with high liquidity, and that's why they enter the market and they buy the bonds in order to splash liquidity into the market to make sure that the engine just keeps running. Well, we have seen this before. We've seen illiquidity in the markets a number of times before, but mainly the two big times that we've seen it, really big times that we've seen it, are in September of 2019, when the Treasury expanded the amount of treasuries that they were auctioning, and so they were asking the market for more liquidity than the market had, because they were running into tax payments in October, and so banks were low on their reserves, and they were holding reserves for tax payments, and then the next thing you know, they ran into some really difficult. They ran into some illiquidity in the markets that spiked the repo market. So the repo market, where banks were looking for cash and they were laying off their treasuries in order to get cash. The opposite of what we've got right now, which is the reverse repo. The banks have flushed with cash, and they're looking to get a return on that. But because of that, and then the second time was obviously in March of 2020, and then it happened again later on between 2020 and here. It's happened a couple times where it got a little bit tight. But what the Fed and what Powell is concerned with, and what he said in not this presser, but the one before, was he said, look, we're watching the reverse repo, we're watching bank balances, and they're not a problem right now, but we're watching for that. And he has said before that when bank reserves get down around $2.7 trillion, that's about the limit they want to see. They want to see reserves stay above that to feel confident that there's enough liquidity for these treasuries in the markets, and they're not going to run into another repo spike. Well, that's not going to be a problem until the reverse repo is drained. Reverse repo is about $400 billion now, and it's decreasing. It got a bump up a little bit from the last month, but we're going to see where it ends up at the end of this month. But it's getting down there. And so once that's gone, and once the bank reserves are down at under $3 trillion, well, I would expect that the Fed is going to call it quits on QT. They're going to just back away and say, okay, we're going to allow this to function normally, or they'll back it off to just a marginal amount, just to say that they're still doing it, $5 or $10 billion a month. And their contention is, by doing that, rather than just stopping altogether or maintaining until they have to stop altogether, it allows them a little bit more runway to peel them off longer term. So
the challenge, according to Lavish, is that the U.S. government is not cutting expenses despite already spending more than it earns in tax revenues. The significant expenses include mandatory spending on Social Security, Medicare, Medicaid, and interest on the national debt, which totals over $5 trillion annually. With tax revenues expected to be around $4.4 trillion, the government faces a substantial budget deficit. To manage this, the Fed continues to print money to maintain liquidity in the treasury markets and ensure the smooth functioning of the financial system. Lavish points out that we've seen instances of market illiquidity before, notably in September 2019 and March 2020. In both cases, the Fed intervened to inject liquidity into the markets. Currently, the Fed monitors bank reserves and the reverse repo market to ensure sufficient liquidity. Once these reserves deplete, the Fed is likely to halt its quantitative tightening QT measures, which aim to reduce the money supply. The key takeaway from Lavish's insights is that institutional adoption of Bitcoin is slowly but steadily progressing. As more institutions buy Bitcoin through ETFs and publicly disclose their holdings, the perceived risk of not owning Bitcoin will increase. This shift will drive more investors to understand and invest in Bitcoin, contributing to its mainstream acceptance. Please like and subscribe my channel.